Money doesn't fail all at once. It doesn't explode, neither does it scream or warn you. Money decays quietly, then collapses loudly. At first, it feels harmless: a little more debt, a little more printing, and little more temporary support. Until one day, the system you trusted doesn't respond the way it used to. Your paycheck feels smaller, your savings feel weaker, and your effort feels disconnected from reward. And nobody can explain why, without lying. What if I told you the greatest threat to your money, your job, your future, isn't inflation, it not war or politics, but a financial machine so large, so interconnected, so fragile, that governments are now afraid to turn it off? Because history shows something terrifyingly consistent. Every time money becomes abstract, disconnected from reality, civilizations don't adapt. They break. Rome learned it too late, 1929, ignored it 1971, disguised it. And today we're repeating it faster than ever. Welcome to The Finance Historian, the channel where we don't just explain money, we expose its memory. Before we go any further, where are you watching from right now? The United States? Europe? Africa? Asia? Drop it in the comments. Because what's coming doesn't respect borders. It doesn't care about flags. And it won't ask permission. And if you're tired of surface-level explanations, if you want to understand how money actually works, not how it's marketed, hit subscribe. Because by the time 2026 finishes unfolding, this conversation won't be optional anymore. If your rent feels heavier, if your savings feel fragile, if the future feels harder to plan than it used to, that's not an accident. It's a symptom. And once you see the pattern, you can't unsee it. Let's start where every monetary collapse begins. Not with greed, not with corruption, not even with bad intentions, but with convenience. In the early Roman Republic, money was painfully simple. Coins were heavy. Metal was real. Value was visible. A silver coin represented actual silver. Gold represented gold. Trust wasn't assumed, it was earned. Rome didn't become powerful because it printed money. It became powerful because it respected limits. But power expands faster than discipline. Wars grew expensive. Borders stretched. Armies demanded payment. Citizens demanded stability. And Rome faced the oldest dilemma in history: raise taxes or manipulate money. They chose the quieter option. They diluted it. The silver denarius, once nearly pure, was slowly mixed with copper. At first, nobody noticed. The coin looked the same. It weighed almost the same. It spent the same. And this is always how it starts. No riots. No panic. No headlines. Just slightly less silver. Then slightly more coins. Then slightly higher prices. Soldiers began demanding higher pay, not because they were greedy, but because their wages no longer bought what they used to. Merchants adjusted prices, not because they wanted to exploit people, but because replacement goods cost more. Savers felt poorer, even though they did nothing wrong. By the 3rd century, Roman coins contained less than 5% silver. The empire didn't collapse because barbarians knocked on the gates. The gates were already hollow. Rome collapsed because money stopped working. And when money stops working, society stops cooperating. Here's the phrase to remember: when money stops representing reality, reality eventually responds. Now fast forward nearly 2,000 years. The Roaring '20s. Factories were booming. Technology was advancing. The stock market only went up. Sound familiar? Credit was easy. Speculation was praised. Debt was invisible. People bought stocks not with savings, but with borrowed money. Some investors paid as little as 10% down, borrowing the rest. Banks loaned money they didn't truly have. Why? Because confidence replaced caution. Everyone believed tomorrow would be richer than today. And once again, when money stops representing reality, reality eventually responds. The crash of 1929 wasn't caused by panic. Panic was the reaction. The cause was truth finally surfacing. Paper wealth that never truly existed vanished. Millions lost jobs. Banks collapsed. Savings evaporated. Not because money disappeared, but because it was never there to begin with. Now we arrive at the most important year most people were never taught to understand: 1971. Quietly, without a vote, without a referendum, the United States ended the gold standard. Before that moment, dollars were promises tied to something physical. After that moment, money became a promise backed by confidence. And debt: no gold, no anchor, no ceiling. This wasn't the end of stability. It was the beginning of something far more dangerous. Because now money could be created without limit. And once again, when money stops representing reality, reality eventually responds. But this time, the system didn't just inflate. It mutated. Rome debased coins slowly. 1929 leveraged stocks dangerously. 1971 untethered money completely. Modern finance went further. It created money. On top of money. On top of promises. A system behind banks. Behind markets. Behind regulation. So complex that most politicians don't understand it. So large that it cannot be allowed to fail. This is where the shadow banking system emerges. Not illegal. Not secret. Just invisible. Derivatives. Rehypothecation. Off-balance sheet leverage. Contracts stacked on contracts. Promises built on promises. By 2008, this system was already enormous. And when it cracked, we didn't dismantle it. We saved it. Trillions injected. Interest rates crushed to zero. And markets learned a fatal lesson. Risk will be rescued. And when a system no longer fears consequences, it accelerates toward collapse. But here's the truth most people miss. 2008 wasn't the peak. It was the rehearsal. Now we need to simplify something that is deliberately kept confusing. What is a derivative? A derivative is a contract that bets on the future value of something else. Interest rates, currencies, stocks, debt defaults. Harmless, until you hear the scale. By the early 2020s, the notional value of global derivatives exceeded $600 trillion. Let that settle. The entire global economy produces about $100 trillion per year, which means the financial system is betting 6 times the value of everything humanity produces annually. This is not investment. This is synthetic reality. Here's the trick they don't explain. Collateral can be reused. Your $1 backs multiple loans. Those loans back multiple bets. Those bets back more loans. This is called rehypothecation. One asset. Infinite leverage. It's the financial equivalent of printing shadows. And when confidence breaks, everyone reaches for the same collateral. That's when liquidity disappears overnight. Shadow banks aren't regulated like traditional banks. They borrow short, lend long, and survive entirely on trust. In 2020, when markets froze, central banks didn't save people. They saved plumbing. Over $4 trillion injected in weeks, just to keep the system breathing. Interest rates stayed near zero for over a decade. That destroyed price discovery. Debt felt free. Risk became invisible. Speculation became policy. Corporations borrowed to buy back stocks. Governments borrowed endlessly. Households chased assets just to survive inflation. This wasn't organic. It was engineered dependency. Now the bill is due. Debt is maturing. Rates are higher. Refinancing costs are exploding. And derivatives built on low rates are now mispriced. A single 1% shift can trigger trillions in losses. And unlike 2008, this system is global. Instant. Synchronized. No pause. No firewall. No reset button. Every collapse in history shares one final phase. Denial. Rome denied debasement. 1929 denied leverage. 1971 denied consequences. And today, we deny scale. We pretend this can be managed. We pretend liquidity equals stability. We pretend debt can roll forever. But history doesn't care about belief. It only responds to imbalance. And this imbalance is unprecedented. 2026 isn't special because of a date. It's special because time ran out. The system is faster now, more interconnected, more leveraged, which means when trust breaks, it won't crack. It will snap. When systems reach this stage, something strange happens. Leaders stop asking what's right and start asking what's survivable. Because once debt reaches a certain size, there are no good options left, only less painful ones. This is where we are now. Let's address the question quietly avoided by every central bank press conference. Why don't governments just raise interest rates, fix inflation, and reset the system? Because they can't. Not safely. Not anymore. Here's why. For decades, governments borrowed under the assumption that rates would stay low forever. Entire budgets were built on cheap debt. Social programs, defense spending, healthcare, pensions. Low rates weren't a policy choice. They became structural necessity. Now imagine what happens when rates rise. Debt servicing costs explode. A government that once paid 1% interest suddenly pays 4, 5, 6%. That doesn't sound dramatic until you apply it to trillions of dollars. Every 1% increase equals hundreds of billions more in annual payments. Money that must come from somewhere. Higher taxes, reduced services, more borrowing. There is no fourth option. This is the debt trap, not conspiracy, arithmetic. Now let's talk about something far more personal. Pensions, retirement funds. The money millions of people believe is safe. Most pensions rely on assumptions. They assume stable markets, predictable returns, low volatility, liquid assets. But those assumptions only work in a low-rate, high-liquidity world. When rates rise, bond values fall, stock valuations compress, derivatives misprice, and pensions don't adjust fast. They can't, because pensions are slow money inside a fast system. To survive, many funds quietly moved into private credit liquid assets leverage strategies not because they wanted risk, but because low rates forced them there. Now those same funds face refinancing stress. And here's the terrifying truth. Pensions don't fail all at once. They quietly reduce expectations. Lower payouts, delayed retirements, temporary adjustments that never reverse. By the time people notice, the money is already gone. Central banks love one word: liquidity. Whenever something breaks, they inject liquidity. Markets rally, headlines calm, confidence returns. But liquidity is not stability. It's anesthesia. Liquidity doesn't fix broken balance sheets. It delays pain. And the longer pain is delayed, the worse it becomes. Think of liquidity like oxygen. Necessary in emergencies. Deadly if you believe it cures disease. In 2020, markets froze. Not slowly, instantly. And the response was historic. Unlimited support. Emergency facilities. Backstopping everything. And it worked. Which taught markets something dangerous. The floor exists. So leverage increased. Risk returned. And speculation grew larger than before. Because the system didn't learn restraint. It learned confidence. Rome collapsed over centuries. 1929 unfolded over years. Today, systems operate at the speed of algorithms. Trades execute in milliseconds. Margin calls trigger instantly. Liquidity disappears before humans react. There is no slow unwind anymore. Only sudden freezes. And when trust breaks in a system like this, it doesn't leak. It drains. The real danger isn't losses. It's correlation. Everything falls together. Stocks, bonds, real estate, currencies. Diversification stops working. Because diversification assumes independence. This system has none. Let's return to interest rates. Because this is where the real fracture lives. Modern finance is built on rate assumptions. Trillions in derivatives depend on small movements staying small. Interest rate swaps, futures, options. They are not designed for sustained volatility. Even a modest rate miscalculation can ripple violently. Banks hedge. Funds hedge. Everyone believes they're protected. Until everyone hedges the same way. Then protection becomes exposure. And exits vanish. This is why central banks speak carefully. They aren't managing inflation. They're managing panic. Every cycle, we hear the same promise. A soft landing. A controlled slowdown. A gentle reset. History shows something brutal. Debt-driven systems don't land softly. They stall. They fracture. They seize. Soft landings assume balance. This system is unbalanced by design. The longer it's supported, the more fragile it becomes. When collapse finally arrives, it never hits first where it's deserved. It hits where resistance is lowest. Wages lag. Savings dilute. Housing becomes unreachable. Meanwhile, assets recover first. Because liquidity flows upward. Always has. Always will. This is an ideology. It's structure. Money created enters financial markets first, then slowly leaks into the real economy, weakened. By the time it reaches workers, prices have already adjusted. This is how inflation hides redistribution. Now let's be precise. 2026 isn't a prophecy. It's a convergence. Massive debt refinancing, derivatives repricing, demographic stress, political pressure, monetary exhaustion, all arriving together. This system can survive one shock. Maybe two, but not synchronized ones. History doesn't repeat because people forget facts. It repeats because incentives don't change. There is one belief holding everything together. That central banks are in control. They aren't. They're reactive. They don't steer the system. They respond to it. And when reactions arrive too late, they amplify the damage. Every monetary system dies the same way. Not with empty vaults, but with empty trust. As long as people believe tomorrow will function like today, the system survives. The moment that belief cracks, numbers stop matching. Money is not paper. It's not digital entries. It's not coins or code. Money is a shared belief system, a collective agreement that effort today will be rewarded tomorrow, that savings represent future security, that contracts will be honored. Once that belief weakens, people stop cooperating. They rush to convert promises into things: food, land, energy, hard assets, skills. This is why monetary collapses don't feel like math problems. They feel like behavioral shifts. Suddenly, people hoard, long-term planning vanishes, trust between strangers erodes, short-term survival dominates. This is not panic. It's adaptation. Here's the uncomfortable truth. Most collapses don't begin with hyperinflation. They begin with confusion. Prices don't explode. They fluctuate. Wages lag. Contracts shorten. Businesses stop offering long guarantees. People feel something is wrong, but can't articulate it. So they blame symptoms: greed, politics, foreigners, corporations. But beneath it all, money is losing its role as a stable reference point. When that happens, everything becomes negotiable. Currencies don't collapse because of debt alone. They collapse when holders lose patience, when investors stop rolling debt, when foreign buyers demand higher premiums, when domestic savers quietly look for exits. This is not dramatic. It's subtle. Bond auctions weaken. Demand thins. Central banks step in quietly. Until one day, they step in loudly, and everyone notices. That's when confidence breaks. Every government believes it can print just enough. History says otherwise. Printing is addictive because it works at first. It delays defaults, calms markets, buys time. But every round requires more than the last. Because trust erodes. And once trust erodes, the dosage increases. This is not malice. It's desperation. No leader wants collapse on their watch. So they push it forward, and forward, and forward, until forward disappears. Here's what most financial documentaries get wrong. They focus on markets, charts, indexes. But collapses are lived socially, not financially. People don't wake up to system failure. They wake up to rent hikes, job instability, vanishing benefits, constant uncertainty. The emotional cost comes first. The financial cost comes later. By the time collapse is named, it's already finished its work. History shows clear patterns. Those who suffer most: fixed income earners, cash savers, those dependent on promises, those who adapt fastest. People with flexible skills, those who understand cycles, those who diversify behavior, not just assets. This is not about fear. It's about awareness. Awareness allows adjustment before panic. Many people believe collapse brings clean resets. It doesn't. It brings rearrangements. Power doesn't vanish. It shifts. Rules don't disappear. They're rewritten. The goal isn't to predict collapse. It's to understand transition. Because transitions reward preparation. Every generation believes its crisis is unique. But this time is different in one critical way: speed. Digital money moves instantly. Capital crosses borders invisibly. Trust breaks faster than institutions can respond. There will be no long warning phase. No slow decline. Just sudden realizations. That's why awareness matters now, not later. Awareness is not panic buying. It's not hoarding. It's not doom scrolling. Awareness is clarity. Understanding how money works. Why incentives matter. Why systems behave the way they do. It's the difference between reacting and positioning. Every monetary era ends the same way, with people saying, "We didn't know." But the truth is, the signs were always visible. They were just uncomfortable. And discomfort is easy to ignore until it's unavoidable. This video isn't meant to scare you. It's meant to wake you up. Because awareness is not pessimism. It's power. Understanding cycles doesn't make you helpless. It makes you early. Every civilization faces this moment. Not will money fail, but will people understand it before it does? Because once trust breaks, explanations come too late. If this video made you uncomfortable, that's good. Because comfort is how systems keep people asleep. Share this with someone who still believes this time is different. Subscribe to The Finance Historian if you want context before chaos, understanding before headlines, history before repetition. And ask yourself, honestly, are we wiser now, or just repeating the same story?